Hi, my name is James Robinson. I own Robinson Stocks. I manage money for a living, and this is my stock pick of the week. This is the last video on the company Encore Wire, symbol WIRE. Usually I do a video on the company's dividends and dividend policies and the growth and safety of the dividends. However, the dividends for this company are less than 0.1% of the value of the company, and therefore I just think the dividends are so low that nobody is buying this company because of the dividends. So I'm not going to waste time doing a video on it. So today we're going to talk about wealth creation, which is the things that the management does or can do to create wealth for the shareholders outside of paying dividends. So they can buy back stock, they can pay down debt, they can reinvest money in the business, they can increase the amount of cash they have. And we're going to look at which of those levers this company is pulling, how good a job they're doing, and whether they're really creating wealth for shareholders. The first lever that a company can pull in terms of creating wealth for the shareholders is repurchasing shares. And so the way that we analyze that is we simply look at the number of shares outstanding over time. Hopefully we'll see the number of shares is decreasing over time. And that means the company is utilizing our funds to buy back shares. The benefits of that are several. First of all, if there are less shares outstanding, that means we own a larger percentage of the company than we used to. And if we own a larger percentage of the company than we used to, even if the company is worth what it used to be worth, because we own a larger share, it's gone up in value. Typically, though, the companies that I choose, the earnings are increasing at the same time as we're owning a larger and larger percentage of the company. And that's kind of a double whammy. So we really like that. Additionally, when you buy back shares, one of the things that's happening is the amount of earnings that the company has, which hopefully are increasing, are then being divided by a fewer number of shares. So the company's earnings per shares are going up disproportionate to the earnings. And in time, that should mean that the value, the stock price of the shares will go up because, again, we own a larger percentage of the company and we own a larger percentage of a bigger number of earnings. So that's what we're sort of hoping will happen when we look at shares outstanding. For this company, you can see the shares outstanding. There hasn't been a lot of changes. From 2009 to 2011, they bought back a lot of shares. Then it's been very, very static until 2019. But from 2019 until now, the company's bought back about 20% of the company. And as we'll see in the next slide, that's really going to create value for us, the shareholders. So we'll go to the next slide to sort of talk about that. The way that I try and analyze the value of these stock repurchases is I say, if we'd owned 10% of the company 10 years ago, what would that look like today? So if we'd owned 10% of Encore Wire 10 years ago, that would mean we had bought 2.33 million shares. Today, through stock repurchases, our 2.33 million shares has gone from owning 10% of the company to owning 12.066% of the company. So it's about a 20% increase. So we didn't spend any money as investors. We just held on to the stock. And during the time we held on to the stock, we went from owning 10% of the company to 12% of the company. We got 20% of value. In addition to that, as an owner of the company, we sort of would have what's called owner's earnings equal to 10% of the earnings of the company. So the company made about $46 million 10 years ago. That means that our owner earnings would have been about $4.69 million. Today, though, that same owner earnings on those same 2.33 million shares would equate to 65.33 million shares. So looked at another way, the earnings would have gone from 91 cents a share to, get this, $26.22 per share. So that's an increase of 2,781% over 10 years. Now, again, we're going to talk about this in a minute because it's a really big number. And I mean, that's like, fantastic. One of the things that's happening is that this is a cyclical industry and we're at the peak of the cycle. 10 or 12 years ago, the company was closer to the bottom of the cycle. So we're getting the benefit of that right now. But the good thing is that the company's value has not gone up as much as the earnings have. This company is still trading at 4 times earnings. So everybody thinks this company is going to go back to what it was earning, and it may well. And if it does, that's okay, because if the earnings get cut by 75%, I still own this company at 12 or 16 times earnings, and I'm okay with that. But in the meantime, this company is buying back shares dramatically. Almost all of the share repurchase, almost all of that 20% share repurchase has happened in the last year or two, and that trend is continuing quarter after quarter after quarter. In the last quarter, this company bought back 4% of their shares in one quarter alone. So this is a fantastic number. We really like it. This is one of the reasons why I'm telling you should buy this company, because if the company's buying back 20% of the shares, if the earnings remain flat, you're getting a 20% rise in earnings per share, and that likely means a 20% increase in the value of the company and the value of your stock. Another thing that I like to look at with companies is shareholder equity. So shareholder equity is simply the total number of assets this company has minus the total number of liabilities. And you can see this company's shareholder equity has gone up dramatically from 2001. It was, I don't know, let's call it $100 million in 2001. And today it's $1.4 billion. That's a fantastic return on shareholder equity. It's gone up every year except one, and that of course was during that giant recession in 2009 and 10. But basically it's gone up almost in a straight line from 2011 to 2019, and then it's gone up dramatically over the last year or two as we've benefited from this market. Shareholders' equity per share, as we've talked about, will have gone up about 20% faster than that over that period of time. And it's gone from, let's call it $1 or $2 of shareholder equity per share to $70 of shareholder equity per share. This is growth chart kind of numbers, and we're getting in an old-line manufacturer that's making wire out of copper, for God's sake. So this is really fascinating. This is an example of a management that's doing a really, really good job. They're taking our earnings and they're doing really, really good things with them. And that's why I do this research on what I call, wealth creation. I want to understand if the company is wasting our money or if our company is using our money intelligently. So even though they're not paying a dividend, they're finding lots of ways to enrich us. One of the biggest things that us value investors, especially in sort of the newer, non-Graham and Dodd, but more Charlie Munger avenue of value investing, look at is return on assets. So it takes money to make money. Everybody understands that. The question is, how much money does it take to make how much money? And so what we do is we basically say, how much total money does it take to run the business? That's the assets. And then what are the profits as a return on those assets? And you can see that, about the goal here is the top 10% of companies are about a 10% return on assets. That's a fantastic return on investment. The top 25% of companies are doing a return on assets of closer to 7 or 8%. And this company really, since going back to 2012, has been in the top 25% of companies. That's really, really good, especially when we see that the return on assets are being used efficiently. They're being used to buy back stock. They're being used to run the business intelligently. And then, of course, you can see that from 2019 till 2020, this number's gone through the charts. The return on assets are just really off the charts. Really spectacular. I don't necessarily expect that to continue forever. It doesn't have to. If it just continues for a few years, this will turn out to be a spectacular investment. And again, this might not be an investment that I hold for 10 or 15 years. This might be one that I get all the value I can while this company's booming, and then I bounce out to something else, but I've got a nice return for my time that I've owned it. Another measure that people use in looking at returns is return on shareholders' equity. I, as I say in every video, don't put nearly as much stock in this because what that return on shareholder equity does is it measures virtually the same thing, except that it gives the company value and benefits for taking on a bunch of debt. So return on assets is the total amount of assets you have. How much money did you make? That's the number. Return on shareholder equity is how many assets do you have and then how much debt do you have. So you subtract the debt from the equity, the debt from the assets, and then you have equity. And so that'll be a much smaller number. So just using round numbers, if you have $1 billion of assets and you have $900 million in debt, well, now you only have $100 million in equity. And the result of that is that the same amount of money is going to generate 10 times the return on equity. But you've also taken on a tremendous amount of risk because you've got all that debt that you have to pay off, even in the bad times. So I don't pay a lot of stock to that, but some people do. And so you can see, again, this company is in the top percent of companies on return on equity. And the reason that it's so low relative to it's not in the top 25% of companies between 2007 and 2020 is simply because the company has no debt. And so they're not getting the benefit of being levered up to get this fantastically high return on equity. But even though they have no debt, for the last year, they've got a return on equity of almost 50%, which is unheard of. That's, tech company numbers. So again, just another reason that this company is uniquely situated for today's environment. One of the things that a company can do with their profits is they can retain those profits and keep them in the business. And when they retain those profits and keep them in the business, the hope is that they're using that money intelligently in a way which will create wealth for the shareholders. But we don't always know what they're doing with the money, and it's not necessarily easy to tell. One of the real problems that you have with an old line manufacturer is that oftentimes they're retaining money to tread water in terms of earnings. They have to spend a certain amount of money on capital improvements for equipment and for plants, and that money is retained, but it's going to potentially generate exactly the same amount of money as they used to make with the old equipment, which now had to be replaced because it's worn out. So when a company retains earnings, especially an old-time manufacturer, that's a real problem potentially. And so I look at the retained earnings. You can see this company's retained earnings have been very, very flat really since 2002. They haven't gone up very much. In 2019, they exploded. In 2020, 2021. But again, that's not a problem because we've seen that they've retained that money in cash, right? So sometimes when you retain money and it sort of disappears, it evaporates because it's been used in the business. Sometimes you retain money and it just stays in the cash folder, and that means that money is still there to be used for other things. It's been retained, but it hasn't been spent. And that's what's happened in this company. And some of the money that they're retaining, it seems like it's eventually going back to buy back shares. So I'm not concerned about this company's retained earnings. Obviously, if I didn't know what was happening, I'd be a little concerned that they went from, retaining $75 or $80 million to retaining $500 million in a year. But I think I understand what's happening with it, so I'm willing to look past it. The next thing that I look at, and when I look at retained earnings, is how efficiently have those retained earnings been used? And you can see that so what I do here is I say, okay, how much money did the company retain over a 10-year period of time? And what happened to those earnings over a 10-year period of time? So I add up the total retained earnings. Let's just say the company over a 10-year period retained $1 billion, just to use a round number. And let's say the earnings during that period of time went up by $100 million. Well, then I would say that company generated 10% return on the retained earnings. They retained $1 billion and they increased the profits by $100 million. I realize that's a dramatic oversimplification, and I realize that it's not completely accurate, but I need some kind of measure just to give me a sense of what's happening here, and that's the one I've decided to use, and just to give me a gauge. So what you can see here is that from 2011 till about 2017, this company didn't do very well in the retained earnings. In fact, from 2014 to 2015, the company actually lost money on those retained earnings. That's a really bad sign, but it's not unexpected. If a company, again, is an auto-line manufacturer, they have to retool the plant every so often. And when they do that, they're going to spend a lot of money on retained earnings and just get no additional profits out of it. So we realize that when we look at these old times earnings. But having said that, from 2017 to 2019, which was normal sort of profit area, this was before the super profits the last couple of years, this company did get a 10% return on investment for the retained earnings. And that's fantastic. And then of course in 2019 and 20, it's just gone crazy. But that's again, because we've had these supersized profits. I would almost look past that, but what I was really encouraged with is the numbers that I saw for 17, 18, and 19. So long story short, it feels to me like this management is retaining a rational amount of money and using that money intelligently and creating value for the shareholders. And they're not retaining a ton of money in the first place. So long story short, in terms of wealth creation, retained earnings, I think, are being used efficiently. So we talked about the retained earnings, and one of the things that they can do with retained earnings is just put them in cash. And you can see from 2012 to 2019, this company went from having about, let's call it $30 or $40 million in retained earnings to about $250 million in retained earnings. That's a 600% increase. And that's before these dramatic last couple of years. For some reason, the cash dropped from 2019 to 2020, but now it's up over 500 million. It shows 400 and some million here, but the last quarter they have over $500 million in retained earnings. And that's despite the fact that they bought back 20% of the company during that period of time. So the cash that this company is hoarding, I think, is becoming a problem. I don't think they need this much cash, and I think they should be returning it to us, the shareholders. I suspect they're going to do that by increasing stock repurchases based on how cheap the company is. They may pay a special dividend. That would also be great. They may use this money to buy some other asset. I would not like them to do that. I don't like it when companies do that. I think asset allocation is something most managers aren't good at. But we'll see what they do with the money, and what I see them doing with the money will inform me on how I need to be holding this company long term. But again, the company is retaining earnings, but they're retaining it in cash, not wasting it on the business, or not inappropriately using it on the business. So this final chart looks at the total wealth created. So what I've done here is I've said, there's a number of levers a company can pull. They can pay down the debt, they can pay dividends, they can buy back stock, they can increase cash. So what has the company done in each of those categories cumulatively over a 5-year period of time? And you can see these things will zigzag. There'll be times that they are saving cash, and there'll be times that they're paying down debt. This company doesn't have debt, but you get the idea. And what's happening here with this company is they had some really good years from 2005 till about 2011. They had that recession, which really kind of hurt them in terms of wealth creation from 2011 to 2014. That's not unexpected with cyclical companies. They tend to be sort of like that, good times and bad times. Since 2014, they've done a very, very good job. And again, in the last year or two, they've done a spectacular job. So this company has done a great job creating wealth for shareholders in the aggregate. Because they're buying back stock so much, I think I like it. So that sort of does it for the videos for Encore Wire, but let's sort of rehash it. The company's trading at 4 times earnings. They don't pay much of a dividend, but they pay back lots of stock. The company is a Odolite manufacturer. Right now, they're benefiting from very high demand and from very low cost of goods sold because copper prices are low. When that is not the case, the company is still profitable. And the company does a reasonably good job of delivering goods and services effectively and efficiently. They've got a little higher plants and equipment, obviously, than we'd like, but we've talked about that. They don't have R&D costs. The inventory costs are in line. So that's all fine. The balance sheet for this company is absolutely rock solid. They have absolutely no debt. They haven't had debt for 15 years, and they've been hoarding cash. Again, maybe too much cash. I'd like them to pay back the cash. And the company's done a pretty good job of creating wealth for the shareholders. The retained earnings are very efficiently used, and they're buying back stock in big chunks right now, which is really exciting. So long story short, this is kind of a small little company no one's ever heard of, but I think you should consider buying stock in it. I don't know that it's a permanent hold, but I think for the time being, you're going to do pretty well with it. So that's it for Encore Wire. I'm James Robinson. Thanks for your time.